Welcome back. Today is Wednesday, June 29th. I can't believe we're already halfway through the year. It's crazy. Been a crazy, crazy road, and ups and downs, bumps and bruises, good times, some bad times, but we're here. And as most of you know, the market's kind of heading into a little bit of murky waters, and that's what we want to talk about today. What I want to do is set you at ease, especially if you live here in the Silicon Valley, the Bay Area, Northern California, to show you what I'm seeing. And again, I am no predictor of the future. I just read the tea leaves and tell you to show you the numbers and let you make that decision, right? The whole idea is to share information with you, and hopefully if you have questions or comments, or you're saying, hey Vito, you're full of crap, please let me know. I'd love to have a comment or a conversation, because it's kind of boring for me just to sit here and talk about numbers, but at the same time I'm trying not to talk about numbers. I'm trying to use those numbers and create a story. Okay, so let's get into this real quick. The last week has been, kind of like the same, a little bit of the same of last week. Lumber's going down, jobs kind of hovering. We haven't had any major announcements. There's some announcements that are threatening, but that's, I think, more highlight, headline type stuff to get you to click. Because that's one thing you have to realize, is that the media is really based on how to get your eyeballs to click the mouse or click on and read, right? Because when we're on advertising dollars and you see an MSNBC or CNN or Fox News headline, they want you to click on it. So it's going to be a term that I heard yesterday, salacious. Not saying that they are, just saying that they're designed to get you to click. And kind of how I set up my email today, what you need to know, right? So let's get into it. Today is June 29th. I've been tracking for the last few weeks. I've been tracking a whole lot longer, but now is the time, I think, that for me to track, it makes sense for me to go and explain this to people and show the numbers so we can have these conversations, right? 40 days on market. That's how this whole thing started. I used that as a baseline, and it's so large right now. My email canceled on me. I am maxed out at 250. Now I have to go to my actual MLS every time I dig up this number and pick it up. Guys, it's not the end of the world when we're seeing 40 days on market get higher. It's not, because a normal market, even back, in the day, back when I first started, a normal market was home stayed on market 30 to 60 days. That was normal here, right? And in, I don't know, I always pick on poor St. Louis, but St. Louis, which I think is in the middle of the US, that was normally, 90 to 180 days, or maybe even longer. And different areas have even longer. And where we trend from seller's market to a buyer's market is 180 days, 6 months. So we're far from, major crash, major buyer's market, everybody's feeding frenzy, that kind of thing. But we are seeing things kind of get back to normal. So people jumping out of the buildings shouldn't happen. People freaking out, walking away from their houses, going to bank owned. That really shouldn't help. It happened. Not yet. I don't know if it's going to happen or not, because we can't tell the future. But right now, if you see the trend, we're seeing houses stay on market a little bit longer. That's absolutely normal. I just started tracking 90 days on market, and we're at 37. A few weeks ago, I would gather that was maybe 15, 18, and those were homes that just needed some serious love, right? They were overpriced, or they were in such horrible condition that they deserve to not be bought. I can think of one right now that's up in the Los Gatos Mountains that's red tagged, and it's been on market for almost a year. And the seller's like, just take it from me. But I think his mindset is, I'm not going to sell it for anything less than what I bought it for. 90 days on market. Again, that's halfway to the buyer's market, right? But we're only at 37, right? Right now, San Jose as a city is 633. And I think, let me check real quick what my numbers are for the market. Yeah, 1,496. That's countywide SFR, single family records, right? Now, understand when I'm looking at these numbers that I'm reporting are single family homes. They're not condos, townhouses, mobile homes, or anything else. They're single family homes, right? They could be attached. They could be like a duplex with 2 APNs. Those are considered single family homes, but they're 2 separate APNs, 2 separate owners. San Jose has been trending upwards as everybody else has, other cities. And guys, if you want me to start looking at another city other than what's out here, let me know. I'm happy to do that. I just added Las Vegas, and we'll get to that. Something really quick, and I'll mention this a few more times, but these numbers right here are, in my head, how I equalize the numbers from city to city to city. So, if you take the average or the square miles of San Jose and then divide it by the number of homes for sale, that's the number you're going to get. So there's 178. There's 3.6 homes for every square mile that's for sale right now. It's the same thing here. For every 1,000 people in that city, in our little city here, for every 1,000 people, there's 0.6 homes for sale. That's how you look at it, right? And we're going to get to these numbers real quick in a bit. You look at Tampa, the numbers are pretty normal. It's a smaller town, but at the same time, 9.6 is pretty recognizable. Something I'm seeing on the Gulf Coast is that the numbers are getting pretty big, right? So 2.8 homes for sale per 1,000 people in Tampa versus 6.62. So you see the story that I'm saying? San Jose is still very healthy, even though we're seeing houses stay on market longer. You look at these numbers up here in Tampa and in Cape Coral and in Austin and everywhere else, you're in 4 digits versus San Jose. We're in 3 digits, right? Mid 3 digits, and we're climbing up there, but we're still a fairly healthy market, right? Cape Coral, what we believe, and this is just from what we experienced over a few days, Cape Coral is predominantly second homes. They're like, yes, Cape Coral is great. I want to live there. That's an awesome place to live. It's an awesome place to Airbnb it. Let's go buy a couple houses and Airbnb, get into that thing that everybody's advertising and, all those Airbnb gurus. And they're like, hey, jump in and jump into the Airbnb and become an investor with that. I don't know how viable that business is going to do right now, because that's one of the things, one of the main indicators is how's travel doing, how's vacation, taking time off. Can you afford to take a time off right now? Or is your job being threatened? Do you want to work as many hours as you can so that you continue to be employed? So you're going to see Tampa, Cape Coral destinations, right? At Las Vegas, which is where we're going to get to, tend to be higher homes on sale. You're going to see those markets decrease a whole lot faster, right? And I actually figured out how to do this. I only have access to the major Bay Area in most of Northern California for pure MLS data. So all this information I'm getting from Realtor.com, which isn't super accurate, but it's just for what the information I can grab. This is good information. So Austin tends to be growing, right? Atlanta's growing, LA's growing, but not like a hockey stick growth of homes for sale, right? That's the indicator when homes for sale hockey stick up and it goes up 40 or 50% in a week. That's when you have to start worrying about that area, right? Which is why we're doing this every week. New York, we're going up slowly, but still it's pretty high. But then compare New York to San Jose. I should get San Francisco, but nobody really cares about San Francisco. Just kidding, Richard. And we're at 0.625 per 1,000 people. New York is 2.3 or 2.4 homes per 1,000 people. That's a lot. That's huge, right? Vegas, not as big of a population. It's actually bigger than San Jose, and not as big of land. However, Las Vegas is like the Silicon Valley, where you have multiple towns, multiple cities, and municipalities within a valley. It's kind of like a valley. Actually, that kind of goes out. But anyway, so there's only going to be so much growth that happens, kind of like the Phoenix area. It's all within an area, and it'll stop growth, and then it'll have to go out this way. Las Vegas, 3,800 homes for sale right now. I'm not saying that it's going to be the crash. Some of my investing mentors are talking about watching Las Vegas very closely, because they're saying it's the canary in the coal mine. One of them, right? I don't know which one's going to be the actual tipping point of dominoes to fall, if that actually happens, but it's just something to keep an eye on. So again, if you have cities you want me to take a look at, now don't come back and tell me, hey, I have these 15 cities. Can you start? I'll maybe add 2 or 3 more, because I do have to work. This information here, I think, is hugely viable, because you can keep a baseline idea of what's going on and keep track of what's going on. And if anything kind of hockey sticks up as far as numbers, then we can have that conversation there. Again, these numbers here, 14.3 homes per 1,000 people. Well, first of all, you can see that it's a destination town, right? 200,000 people to support 106 square miles. Those are all probably second homes or Airbnb homes, right? So people are exiting that market because they're afraid of an impending crash. So, I mentioned that a few weeks ago, and these numbers I had inverted. Nobody caught me on it. So shame on you. No, I'm kidding. It's my fault. I caught it. I'm taking up to, or admitting it as an adult should. REOs is another thing we're going to start tracking. Now, this is Bay Area to Monterey, not going up to Sacramento or what have you. It's, let me see. Can I find it real quick? Do I have it? I don't know what I did with it. I wasn't going to show you. Now I want to show you. Oh, here it is. So it's not a huge number. This is what happens when you work with me. You get a portal looking like this, so you can look at it, talk to me, put notes into each thing. This is really fun to use. But most of the REOs are up here. There's some in Monterey. Oh no, one in Hollister. Nothing down here in Monterey. Down here, Del Monte. Let's take a look at this guy. Maybe. Yeah. So what you're getting right now are homes that I don't think are good values just yet for REOs. Okay, but 17, that's nothing. I used to carry 17 on my listing roster at any given time back in the day, back in like 2008, 2009. We would have 10, 15, 20 houses on market at any given time. So that was me. I was one guy. I wasn't like a major corporation that took over and did it. So what I'm telling you guys here is we're seeing inventory normalize. We're seeing interest rates normalize. We can talk about mortgage rates. A couple of weeks ago, I was saying 6.4, 6.5. As a matter of fact, that's what you're looking for right now. That's what was being quoted. But if you went to Bank of America, I'm not saying you should use Bank of America because, there's reasons why you would go with a broker. They would get you competitive rates like this as well. This is quoted at 4.25 at a 1 million loan, $1 million loan. You're paying, after everything is said and done, 4.1. Now, everything has to be aligned with this one. You have to have 20% down, perfect credit, reserves, money in the bank, great job, everything. And you probably have to buy this down a little bit, which is a great thing that we should be talking about right now. Our rate's going to go down, the value is going to go down. Well, I think what we're seeing is the market contract a little bit. As a matter of fact, right here, we see out of the 600 homes, there's 200 that have decreased, which is roughly 30% of the population out there. But I think this is just the beginning. We're going to continue to see this number go up a little bit, and then it's going to flatten out and go down, because what's happening is people will understand that, I can't ask any number. I have to be a little bit more aware of what's going on in the market, be a little bit tighter with the comps, or maybe be under the comps to attract the buyers. Because if I'm at, say, $1 million, I'm like, my house is worth 1.2. I should list it at 1.2. This happened when the market was going crazy too, right? I would say be very conservative. Don't be aggressive on your price. Don't get anywhere close to where the pricing is right now. I'm actually looking for my dashboard right now, so bear with me. Be conservative with pricing. Don't go crazy. Understand where the market is. Get your house sold. The longer your house is on market, the less likely your house is going to sell, right? And we absolutely don't want that to happen. We want your house to sell. We want to get you moving on into your next part of your life. So be understanding that you might get some lowball offers, but you also will have to work with contingent offers. And we'll go into contingencies in a few minutes, but you also might have to do some different things where you might have to throw some money at points to help the buyer buy down the rate, to make it more motivating for them to do it, or help with closing costs, or actually do some fixes around the house, unless your house is, completely turnkey. If your house is amazingly immaculate, brand spanking new everything, you have a brand new kitchen, you have brand new bathrooms, new stainless steel everything, new doorknobs and finishes and new lamps and everything, and it looks like a model home, you can look for a premium price, absolutely. But be very careful. Don't get greedy. The number one reason, I said this years ago, the number one reason why homes do not sell, it's not because your agent's an idiot. Hubris, greed, ego. It's the number one reason you're in the seller's mindset. My house is worth X, right? We hardly ever will tell you we should go up high. Go as high as you can. Your house is worth $10 million, right? That's not going to happen today, especially today. If an agent's telling you to go lower, it's not because he's trying to screw you over and get a quick commission. It's because he knows what's going on with the market. All right, enough said about that. Again, you might have to put in some equity into the house to sell it, which means you might offer a point or two to lower the interest rates. Here you go. You might have to replace the carpet. You might have to tent the house, right? I haven't done a tenting for my cellar in 5-6 years. I don't think, because I negotiate that out. But today, fully 20 to 30% of the homes that get under contract are contingent on something, right? And there's 4 different types of contingencies. Generally speaking, one is the need to sell your house. If you're a buyer and you have a house, you need to sell your house and take that equity and put it into the new house. That's a contingency, okay? Property condition. That's termite, pest, roof, property, foundation, pool. You have all that inspected so you can present that to the buyer so they know what's going on. Sometimes buyers or sometimes sellers don't want to pay for that. That's okay. You don't do it, and then the buyer can come back and say, I have my right and duty to have this house inspected. I want $20,000 off because there's $20,000 worth of termite damage, right? That's property condition. Then there's loan and appraisal. It's kind of like the same thing, but it's not. Two totally different things. Loan is really on you as the buyer, and appraisal is obviously the value, right? So there's all sorts of stuff that goes into that. So those are now being written into the purchase contracts, and they're about 17 days. So you could be in contract, think everything's hunky-dory, you could be sleeping great, and on the 15th day the buyer pulls out. That's happening a lot. It's happening a lot. So it's our job as agents to make sure that we find a good buyer, one that's willing and that it's not going to be mamby-pamby or walk away for any reason. I sold a house in Morgan Hill, and we closed on it, but we had to keep the deal together. So we helped pay for rent back for a month. There was another buyer that came in, and he was super strong and was like, oh, I'm going to buy this house. I'm going to go to $2 million. And then I'm like, oh, great. And I was negotiating with everybody else. I'm telling you, hey, you're up to $2 million. Can you beat it? Can you beat it? And all of a sudden that buyer ghosted me. Not me, the agent, right? The other agent, they ghosted me for like 5 hours. I'm like, hey, what's going on? What's going on? What's going on? All of a sudden I start talking to other people. I have a second transaction or second offer in place, making sure that that's strong. And then that guy just totally disappeared. And then the agent came back to me and said, hey, we're still ready to go. We're still really, really strong. I'm like, no, I have zero confidence in that buyer whatsoever, just because you ghosted me for 5 hours. And, I'm not going to put that up. I'm not going to put my sellers into that position. I had from sheer experience, knowing how things work, if that buyer's coming at me and saying, oh, I want this, I want that, or I'm just being mamby-pamby in the beginning, absolutely, you lose me. You lose my confidence in you 100% of the time. So there's certain things that you need to be aware of that are going to come down the pike if you're selling your house. And there's certain tools that we can use to implement you to help you buy a house a little bit easier. We're getting a veteran into a house that's contingent because she's using the VA loan, and we're asking for points, and we're asking for closing costs because we can, right? House is on market 15, 16, 20 days. There's not a rush of buyers, so we're going to have to start working that. That's how you work that kind of stuff. Okay, so let's talk about foreclosures real quick. I know we're kind of running quick here. These are the top 10 zip codes that have foreclosures right now. I think these numbers are going to grow. I think these numbers are going to grow in non-strong markets. San Jose, major metropolitan areas are always going to remain fairly strong. These areas, Cleveland, well, Chicago, Illinois, those areas, there's some certain areas that you have to be a little bit aware of. Maybe Chicago, I don't know Chicago at all. That could be in, an area I'm not allowed to really talk about. That's called redlining. I can't talk about that. So anyway, we're expected to see foreclosures happening. Going back to the whole thing here, you're seeing Tampa and Cape Coral. My guess is that foreclosures are going to start happening with those Airbnb investors, because I believe that Airbnb is tightening their profitability, making it more difficult for the individual users to profit what they were used to, so they're increasing their prices. But also, I think travel is going to take a pretty big hit because cost of gas is going up and cost of airline tickets are going up. So these areas right here, Las Vegas, I think you're going to see a huge boom because those are destination cities. That when the going is great, everybody's happy and la-di-da-di-da, everybody's investing, throwing money down, they don't care. They get sucked into the whole I'm an investor thing, and they don't really have the long-term thing. They're just like, I can just scratch in and make this stuff happen, but they don't have 6 months to a year of savings to keep what they have. Because if they have 5 Airbnbs, right, and maybe 2 long-term rentals, and half of those Airbnbs go away, and there's zero income coming in, that you have to start paying into that. So you have to take out of your savings and pay for that, right? I'm guessing that a majority of investors aren't prepared for a 3 to 4 year long-term issue or problem that we might be seeing. And that's where you're going to see foreclosures happening. Talked about that. Everybody's crying about Dow Jones going down. I don't see that as a problem. I think that's just a normal thing. I honestly don't think that the stock market's going to be hit that hard. There's certain companies that are going to get hit hard. Like everything I invest in, I'll tell you what I invest in and then wait 2 days and then buy. Because every time I buy something, it doesn't matter if it's a stock, a bond, an ETF, mutual fund, it just plummets. So wait until I buy something and then wait 2 days and then buy, because you're going to get such a fantastic deal. Just the way it works. Layoffs. That's another thing that we were talking about, right? Now, again, we're talking about salacious headlines to attract your eyes to clicking on it. Now, look at all this, right? You can just say layoffs 2022. It's possibly going to happen, right? Those companies like Netflix, and I own Netflix. And yes, I'm the reason why Netflix is failing right now because I bought their stock. They are going to start laying off. That's a normal thing when your stock goes down. Finance takes over, and they have to plug the holes in the boat to keep the boat from sinking. And one of the holes are labor. So that's a normal thing. You're going to see this all over the place, right? You're going to also see companies doing really well. So I don't know if we're going to go into a recession right away. I don't know if we're going to go into a recession at all. Guy I listen to on podcasts almost every day, he's my Chicken Little. His name is Peter Schiff. He's a social economist, and he talks about what's going on from the treasury side, from stock market side, all sorts of gold and all sorts of stuff. And he seems to think we're in for a big one. My other investor mentors are talking about seeing this happen. You look at some other people talking about it. They're saying that the economy is doing well, employment's great, etc. You have to make your best guess because you're an adult. Be educated on what your next steps are. Be prepared, right? We always tell you to be prepared. You should have at least 6 months worth of money that you spend every month, right? 6 months, have that, because you just never know when something tough is going to happen, right? And that's my guess as to why we're seeing such big numbers here in Las Vegas and Cape Coral. The secondary homes are just an added expense. And if you're feeling a little less confident about your job, that's what's going to happen. All right. I think we've been going 30 minutes. That's way too long for me to talk. So if you have comments, please give me a call or put it down below. I'll respond to you. If you have any really quick things, you can DM me or you can text me. If you have a city you want me to add to this chart, let me know. All right, I'm Vito Scarnecchia with the Albertano Group, powered by Compass. We'll see you out there.